Last year, August 14th to be exact, Kenyans woke up to news that Dubai Bank of Kenya had been placed under receivership. It had failed to meet its debt obligations. And October 13th, 2015, just 2 months after that, Imperial Bank was placed under receivership, with the former CEO, Abdul Malek Jan Mohammed, being accused of running a bank within the bank. He left a hole of 34 billion shillings. This morning, April 7th, 2016, utter shock and disbelief as employees of Chase Bank Kenya met closed doors while customers were unable to access their money. The bank had been placed under receivership after a decision was made at 4 a.m. by the central bank. Chase Bank had literally run out of money after a bank run and was unable to meet its financial obligations.
If you look at what happened at Chase Bank today, it was clearly a case where the details have not come out, but it's a case where there was a statement of numbers, and the numbers, by virtue of that, some director and the CEO and the chairman seems to have been involved, and therefore they stepped down.
Over the last few months, central bank and stakeholders have attempted to retain sanity in the banking sector, afraid to raise the panic button. But even after assurances that the banking sector is sound and solid, the seams are beginning to show. Pressure to report good results and stiff competition in the sector have seen accountants manipulate books, and this is quickly catching up with them.
The books of accounts need to reflect the actual status operations of the bank or of any entity. So they need to be ethical conduct of the business.
In January this year, a 2015 credit officer survey released by the central bank might not have been taken seriously. The report stated that most banks expected their non-performing loan level to increase in the first quarter of 2016, with half of the respondents indicating so. This clearly was an indicator that all was not well in the banking sector. 2015 was a tough year for the banking sector. Several smaller banks faced significant liquidity challenges caused by a 12% collapse in the Kenyan shilling and tightening monetary policy that drove up interbank lending rates and consequently pinching liquidity. As the storm continues to rage, Central Bank Supervision Department has come under intense criticism, with many now doubting that this department was unaware of the dealings within these banks.
The audit report that the auditors normally issue, which basically express the opinion of the financial statements, is going to be enhanced, such that it will not just be an opinion on the set of the financial statements, but there will be key audit matters that will be covered in that particular report.
It appears, however, that the central bank's move to scrutinize bank data and not just looking at financial reports in order to detect anomalies early has perhaps begun to work. The central bank is upping the ante. The suspension of licensing of new commercial banks in order to strengthen its supervisory capacity and drive consolidation of the banking industry has also been lauded as a step in the right direction. Corporate governance, however, has clearly been ignored, with banks getting extraordinary latitude to underreport on risk levels, non-performing loans and the cooking of books. Board members, auditors, accountants and shareholders must now be put to task. Central Bank has maintained the need to protect the financial system, and increased audits and scrutiny of banks could just be the magic bullet needed to restore sanity to the industry. Terry Ann Chabet, Citizen Live at 9.